You have got a brilliant business idea, but here is a question. Should you borrow the money to grow it or give up some ownership? The wrong choice can cost you more than just money. Assalamualikum. I am Author Syed. Welcome back to the channel where we talk about finance, business, and personal growth. Today, we are breaking down one of the biggest decisions every entrepreneur faces: debt versus equity financing. If you are new here, consider subscribing so you don't miss out on more strategies to help you build a business and a life you love. What does it mean, debt versus equity financing? Let's keep it real simple, because this is where most people get confused. When your business needs money to grow, you basically have two paths to raise funds. First, debt financing. This means you borrow money, usually from a bank or cooperative or an ethical investor. You agree to pay it back over time, usually under profit sharing contract or some kind of a pre-agreed fee. Here, you are essentially saying, lend me the money and I will pay you back with a little extra as share of my profit for a fixed time, but the business stays fully mine. The big idea here, you keep 100% ownership of your company, but remember, the obligation to pay remains even if your business struggles. So your cash flow needs to be strong enough to cover those payments. Second, equity financing. On the other hand, equity financing means you bring someone in as a partner. Here you are saying, invest your money in my business and in return, you will own a piece of it and earn a share of the profit for as long as you are a partner. The big idea here, you don't owe any repayments, but you give up a percentage of your future profits permanently. Your investor shares the risk with you. If the business does well, you both win. If it struggles, you both lose. But you also lose some control because now there is another decision maker in the room. Both paths can be halal as long as they avoid interest and are structured ethically. For debt financing, they usually means using mudaraba, a profit sharing agreement instead of an interest bearing loan. For equity financing, that usually means a musharaka, a partnership where both contribute and share risk. So no matter which you pick, keep it interest-free and aligned with your values. Let's take an example to make it real. If Sarah owns a small bakery, business is a good, and she wants to open a second location, she needs $50,000. She has two options. One, debt financing. She goes to a halal bank that agrees to give her $50,000 under a profit-sharing contract. She keeps full ownership of her bakery, but every month she pays the bank their share of profit until $50,000 and the agreed profit share are fully paid. Once it is paid, that is it. The bank walks away. Second is equity financing. She meets an investor who offers her $50,000, but in return, he wants 30% ownership of her business. Now, Sarah doesn't own any repayment, but she also doesn't fully own her bakery anymore. From now on, 30% of all profit goes to her partner, and every big decision needs to include him. Advantages of debt financing. You keep full ownership of your business. Once you pay off the loan, it is done. You don't owe anything more. You keep all future profits to yourself. But you are obligated to pay no matter what, even if business is slow. Those regular payments can put pressure on your cash flow in the every month. Advantages of equity financing. No repayment, you don't have that monthly pressure. Your partner shares the risk with you. If you lose money, you both lose. Easier if your cash flow is tight at the beginning, but you give up a share of your future profits forever. Every big decision now needs your partner approval. You lose a little control over the business. Here is something most business owners don't realize. Sometimes the cheapest money is the most expensive. Why? Because giving up equity might seem easier today, but over 10 years, 30 years of your profit could be worth $1 million. So think long term, not just what feels comfortable now. So which path is right for you? Here is the simple framework to help you decide. If you have a steady, predictable cash flow, lean towards debt. If your business is risky, unpredictable, or just starting out, equity might make more sense. Always make sure your financing is interest-free and ethical. Choose partners who share your values, and whatever you choose, get it in writing with clear terms and expectations. I would love to hear from you. Which path do you prefer? Keeping full ownership or bringing on a partner? Drop your thoughts in the comments below. I always enjoy reading them. And if you found this video helpful, give it a like. It really helps more people discover this content. Until next time, Assalamualaikum.